Good day, everybody. Chris Heerlein here of Reap Financial coming to you with this week's Wealth Report. It's October 31st, so happy Friday, happy Halloween to everyone. Glad to be with you. All throughout the year, our team of advisors, we focus relentlessly on two things. One is your long-term security and clear and honest communication. This is why I take valuable time out of each of my weeks to bring you updates on what's going on in the economy, what's going on in the equity markets, so that you can stay on top of things, stay educated, and in front of opportunities. And that's why I want to talk today about the headline that's dominated the financial news this year. The headline, this stock market is constantly setting new records. So get this, the S&P 500 index has hit approximately 35 all-time closing highs already this year. And when the market is hitting new peaks, I know what many of you may be thinking, because it's natural. It's a natural human reaction. You're asking yourself, is it finally time to sell? Am I buying at the top? You check your portfolio on another record-setting day throughout the week, right? It feels like being on a mountain peak. It's thrilling, but you can't help but look down and wonder how far that fall might be. The reason I'm talking about this is the financial media loves to feed that fear. And on a day like today, Halloween, the air is filled with ghost stories and spooky costumes and trick-or-treating. The market headlines, they often give us their own version of a good scare. They'll pull out that classic cautionary tale, and you've heard it before. October 9th, 2007, the S&P 500 set a new all-time high that day. And just a year later, we were in the depths of the financial crisis, and the index was down about 40%. The market didn't fully recover that high until 2013. So yes, it's a powerful anecdote, but at Reap Financial, we don't build long-term strategies based on single anecdotes or an occasional scary example. We build your retirement future based on comprehensive data and proven retirement planning methods. So let's look at it this way. What does the historical data actually say about buying or holding stocks when the market's at an all-time high? This data is surprisingly clear. New record highs are not a reliable sell signal. In fact, they are often a characteristic of an extended bull market. Since 1953, the returns of the S&P 500 index after reaching an all-time high have been only fractionally lower than the returns after any random trading day. Over 1 year, the average return after a new high was 8.4%. That compares to 9.2% after all trading days. It's a slightly lower return, yes, but certainly not a disaster and not a reason to panic or even consider abandoning your plan. But with all that said, here's the most compelling piece of data, and it speaks directly to our philosophy of protecting your capital. A study by Cambria Investments looked at a system where an investor only held stocks when they were close to their recent all-time highs. They found that this strategy since 1926 produced a slightly lower long-term annualized return than just holding stocks, but with one critical advantage: much lower volatility. The maximum historical deadline, that peak to trough drop for investors who just held stocks, was brutal. It was down 83%. For the strategy that only held stocks near record highs, the maximum decline dropped to just over 29%. So what can you take away from this? It suggests that when the market is reaching new highs, it potentially could be a relatively safer period in the cycle. What it is confirmation that the current fundamental trends are strong. The conclusion is simple and reassuring. Record high prices alone are not a good reason to avoid buying or holding stocks. And when we look at the fundamentals today here, we see an economy that's engaged in a really unusual and intense tug-of-war. We have genuine weakness pulling us in one direction and great strengths pulling us in another. So it's no wonder that so many analysts out there are confused. Let me share with you what we specifically see as signs of weakness. These things are the headwinds that have kept the recession alert active since all the way back to 2022. The first sign is that manufacturing is actively declining. Not just here in Central Texas, but across the U.S., the housing market is struggling. Prices have dropped dramatically, and this is really due to the weight of high interest rates. A key recession indicator that has historically been reliable has been triggered, most notably the inverted bond yield curve, which signals trouble ahead. And finally, the labor market has shown clear signs of losing momentum, with job openings falling and wage growth sliding back down. So these are real concerns, and we're paying very close attention to every single one of them. But now let's look on the other side of the fence. Let's look at the great strengths that have kept a full-blown recession at bay. Despite job creation slowing down, surprisingly, the unemployment rate remains historically low and, more importantly, stable. It's true, businesses aren't rushing to hire, but they're also not rushing to fire. Now, some industries, particularly tech, can be more sensitive than others, but it's a holding pattern right now. It's not a collapse. Household income growth is remaining solid. While wage increases aren't at the peak levels of the pandemic, they're still higher than they were in the years leading up to 2020. But I believe this is one of the most important. Household spending continues to grow. The consumer, us, that drive the U.S. economy, is maintaining their confidence in spending despite these known weaknesses. All throughout the year, we're necessitating strategies that are built on balance and diversification, not on making huge or speculative bets on one single outcome. So as we look ahead, especially into 2026, I believe there are several powerful factors that suggest economic growth could actually increase. First, policy is shifting from headwind to tailwind. This is a good thing. And in past weeks' wealth reports, I've discussed this, but the Federal Reserve has started to reduce interest rates. It's happening. So far, this has been a modest but clear boost for the economy overall, and specifically for interest rate sensitive sectors like housing. I think we could see the housing market turn around dramatically over the next 24 months. Simultaneously, the negative effects of the recent trade and tariff policies are fading. There's clarity coming into the markets around how this is actually going to play out. Second, we talked about the One Big Beautiful Bill Act. This is stimulus, and this stimulus is finally scheduled to hit consumers' bank accounts. While some of these benefits have already hit retroactively, the major impact is going to be felt by most people when you file your 2025 tax returns, let's say in April 2026. This is a scheduled injection of capital into the consumer economy. Third, and perhaps the most critical, is the immense sustained impact of artificial intelligence spending. AI investment has been the single most important factor supporting economic growth in 2025 and in helping avoid a recession. But what's crucial here is the source of this stimulus. It has come almost entirely from the cash flow of major technology and investment firms, not from debt. This makes the growth far healthier and more sustainable long term. These massive investments, they're acting like a major private sector funded tax cut, and I expect this spending wave to continue well into 2026. Now, obviously, the AI revolution introduces its own complexity. That huge surge in spending fuels growth, which can be inflationary, but it seems that AI's core purpose is to dramatically increase productivity, which can be powerfully deflationary. It's another great conflicting force that we're going to be managing. So let me close here. I believe that everything I'm discussing, this really brings us full circle to why you engaged us at REIT Financial. In a stock market environment that's defined by record highs, and then we've got conflicting economic signals, we've got rapid technology change, it can be tempting to jump to extremes, there's no doubt, and that's either by getting greedy or becoming paralyzed by the market ghost. As your fiduciary partner, our job is to keep you grounded in data and committed to your long-term plan. Each and every week, we're focused on the quality of the foundation you've built with us, which is why we continue to emphasize maintaining balance and strategic diversification in your portfolios. We design your wealth to withstand the economic tug-of-war that I'm discussing. We want you to participate in growth of this AI boom. We want you to benefit from the policy tailwinds that likely are on the horizon. Trust the plan, trust the data, most importantly, trust that we are constantly monitoring these complex issues for you and your family. As always, thanks for tuning in with me throughout the month. I hope you have a wonderful and safe holiday weekend. If you have any questions about your specific plan, any changes that are coming up here at the end of the year, do not hesitate to reach out to our team of advisors. Until we speak again, all the best to you and your family.